Welcome to CGD's conference call. This call follows the fourth quarter 2018 earnings release, which took place last Friday. It is possible to follow the earnings presentation from CGD website. The CFO, Mr. José de Brito, and the head of IR, Mr. Bruno Costa, will guide you through the presentation, and a Q&A session will follow.
Hi, good afternoon, everybody. This is Bruno Costa, head of IR at Caixa. I'd like to welcome you all to this conference call where we'll talk you through the 2018 results that we announced last Friday. I'm sure you all have the presentation that we posted on our website as well as on CMVM's website. At the end of the session, there will be opportunity for Q&A. Without further ado, I'll hand over to Mr. de Brito, our CFO, to lead you through the presentation.
So good afternoon, and thank you for joining this conference call. So I will guide you through the presentation, and without further delays, we can start with slide 4, where we present the main highlights of these 2018 results. In fact, we can see in comparison to 2017 that our core operating income increases to 14.6%, based on the increase in the domestic activity, namely on interest margin and on commissions, that were up 7% in CGD Portugal. With that, the group was able to achieve a consolidated net income of 496 million, in comparison to 52 million back in 2017. And this translates in a return on equity of 6.6%. Also, capital ratios improve, reaching the CET1 14.7% and the total ratio reaching 17% in the end of 2018. These ratios include the net income of the year. Also, in terms of the NPL and following the strategy that the group is pursuing since 2017, the NPL ratio was reduced to 8.5%, and the coverage by impairments increased to 63.5%. Also to highlight, and I think this is of course already known, but we also highlight the 3-notch rating upgrade by Moody's during 2018, and also the 1-notch upgrade by Fitch in the end of last year. On slide 5, we have the main targets on the strategic plan and also the management targets for 2018, where we can see that we achieve a pretty good execution in all of them, with a return on equity of 6.6 compared to a target of 5%, the recurrent cost to income of 52% below the management target of 55%. Also the NPL ratio, where we had a management target to become below 2 digits, and in fact we achieve 8.5%. And finally, the capital ratio, CET1 fully loaded, where we have an initial target of 13.5%, substantially above the target on the strategic plan, and we achieve 14.7%. Moving to slide 6, just to inform the market that the sale of our international subsidiaries, namely in Spain and South Africa, were already approved by the Portuguese government. Nevertheless, as they are both still subject to approval by local authorities in each of the countries, they weren't reflected in 2018 accounts. As we already communicate to the market, I think back in November, when both sales were finalized, they will contribute to an increase of the capital ratios of more than 100 basis points. Also, some information on the sale of the other subsidiaries, namely Brazil and Cape Verde, where the processes are on course, and we just expect Brazil to be closed by the end of this year, and Cape Verde probably only next year. On slide 7, we have the rating evolution. I will skip this, as this is already new by the market. And on slide 8, we present the management targets for 2019 and 2020, where we can see that we envisage to achieve a return on equity above 7% in this current year and above 9% in 2020, which is the target from the strategic plan. In terms of cost to income, the management targets are to be below 50% this year and below 43% in 2020. And on the NPL ratio, the management targets will be to be below 7% in 2019 and below 5% in 2020, where you can see that is substantially below the target for the strategic plan. In terms of CET1, our targets are to keep this robust position and to have the CET1 above 14% for all these 2 years. On slide 9, we present some data on the digital platforms of the bank, where we can see that we have in fact a sustainable growth in terms of clients using these digital platforms. Also on the next slides, slide 10 and slide 11. Slide 10 is some marketing materials from the digital banking offer. In slide 11, we have the number of customers that are already using our digital platforms. And finally, on slide 12, we have the transactionality of our digital banking, where we can see a substantial growth since last year. But more than this, I would highlight the sustainability of this trend of getting more clients to these platforms. On slide 13, we have some reference to some of our market shares, where we can see that the group is in fact leader in many of the business lines in the Portuguese market. And I would like to highlight the market share in terms of household deposits, close to 30%, and also on mortgage loans, close to 25%. But nevertheless, I think this global picture gives a good view on the leadership of CGD in Portugal. On the right side, also some prizes and distinctions for the group, and I will move to slide 14, where we also have some relevant events during this year in terms of the different the corporate business and the business with individuals and households. And there I will just highlight the success of Contas Caixa, which is a bundle of products that the group launched last year, and which has been the main driver for the growth in the commissions in the domestic activity. So moving to the numbers. On slide 16, we present the net income, 496 million, close to 500 million, and a return on equity of 6.6%, which is the same if we look just to the current activity, which means that we don't have significant extraordinary results in 2018, contrary to what happened in 2017, where, as you should remember, the group decided to provision all the extraordinary costs envisaged with the implementation of the strategic plan. In the press release, we have more detailed data, and you can see that last year we made more than 600 million in provisions for this purpose, and in this year of 2018, as previously mentioned, we have no significant provisions related to the implementation of the strategic plan. If we move to slide 17, we have the quarterly evolution of the net income. I think it's important to mention that the decrease from the third quarter to the fourth quarter is mainly related to the trading results, which in the third quarter were positive in a significant amount, and in the fourth quarter were negative due to the environment in the financial markets, especially in the end of the year, in the last December. In fact, if we look on slide 18 just to the net core operating income, we see a pretty much stable trend, but also increasing, which is of course important for us and is the sustainability for future income. On the right side, we have the comparison to last year, where we can see that the net core operating income increased 14.6%. And what are the reasons for this increase? Starting on slide 19, looking at net interest income, where we can see that we have in fact a decrease of the net interest income of 2.9%, but as already mentioned in previous occasions, this was mainly due to the currency devaluation in some geographies, particularly in Angola, because if we exclude the currency devaluation impact, we can see in the right side of this slide that the net interest income would have increased by 2%. Also important to mention that we have an increase in the domestic activity in CGD Portugal of 2.1%. It's also important to refer that we don't expect to continue to have increases in net interest margin, or at least so significant like we had last year and at a certain point this year in the domestic activity, because as you might recall, I mentioned that this evolution is mainly coming from the repricing of liabilities, and this process is almost ended. So we still have some wholesale debt, namely covered bonds, maturing in the near future. This, of course, will contribute positively to the net interest income, but from the deposit base, this repricing is almost done, and we shouldn't expect substantial contributions to the evolution of net interest margin. And this is what we can see on slide 20, where the net interest margin really improves, not only in the domestic activity, but also on the consolidated activity, and this improvement is coming mainly from the liability side. Looking at net fees and commissions on slide 21, we can see an increase of 2% both in domestic and consolidated terms. This is slightly below our initial targets due to some extraordinary impacts, but we can expect this to continue to grow for the years to come, and maybe above the 2% evolution of 2018. Also, an important driver for the net income was the evolution of costs that we can see on slide 22, where we can see that we have a substantial cost reduction in all the items, not only in terms of employee costs, also on the administrative expenses and depreciation and amortization, leading to a total decrease during the year of 11%, on top of the decrease that was already achieved in 2017. This is particularly important for us because, as I already showed, we have a very demanding target of 43% for the cost to income for 2020. And of course, we will work on improving the income, but it's also important to continue to improve the efficiency of the group. On slide 23, we show the evolution of employees and retail branches in the domestic activity. The evolution is totally in line with the strategic plan agreed with the European Commission, and this translates on slide 24 in the cost to income of 52%. Of course, the reduction since last year was just 1%, but we should bear in mind that last year the group registered very substantial trading gains, results from financial operations, which in fact mean that the final cost to income benefiting from that. On the right side, if we look just to the cost to core income, we can see there a substantial improvement of 6%, and this is what we can consider the gains of efficiency in the group during last year. On slide 25, we have the contributions from the international activity and the domestic activity of the bank. The reduction on the international activity was mainly caused by the non-extraordinary gains registered this year in 2018 in comparison to 2017, where we have some extraordinary gains in Brazil, and we have this footnote referring this, but also in Spain with some transactions that we consider non-recurrent. If we look at the main contributions from our subsidiaries and branches abroad, we see that continues to be BNU Macau and BCI Mozambique the main contributors for the results on the international activity. So moving to slide 27, we have the market shares in Portugal, strong leadership in terms of deposits, especially on households, but also leadership in terms of credit, in particular in terms of mortgage credit. On slide 28, we have the evolution of customer resources in Portugal, where we can see a substantial increase in the deposit base and also in terms of bank assurance products. And the others don't have substantial changes. Just to mention that the reduction in bonds is due to the maturity of a retail bond that we decide not to renew in our retail clients. On slide 29, we have the evolution of the loans and advances, and in fact we can see that we have reductions in all segments. We have reductions in corporates, in general government and households, and this was mainly driven by also two main aspects. First, the policy of reduction in the NPLs. Of course, these are gross loans and advances, and it's impacted by the NPL reduction. Also, to mention that we have, in the end of last year, substantial reimbursements from public companies and general government, which means that it's also an extraordinary movement and is not market related. It's a consequence of the good treasury position of the government and the public companies. On the left side, we have the evolution of loans and advances, excluding the NPL and excluding the general government and public companies, and here we can see an increase of 1.4%. You can, of course, we can say that, okay, but with the loan book growing, shouldn't we expect improvement on net interest margin? The problem is that the spreads are much pressured in the Portuguese market. We see a fierce competition between the different banks in Portugal. So we are thinking, and we will continue to try to grow on our credit portfolio, but we are not envisage substantial gains in terms of margin, of interest margin, due to this competition. On slide 30, we have the evolution of loans to corporates, excluding construction and real estate. And why excluding these sectors? Just because we have a high concentration of NPLs in these specific sectors, construction and real estate. So this is what we can consider the real economy credit portfolio. On the right side, we have the evolution of loans to SMEs, where we can see an increase in all the different segments. Also on slide 31, on specialized credit, we see a good evolution in terms of new factoring, confirming and leasing transactions, all of them above 2 digits, and this is an effort that the group intends to continue to develop. Finally, on slide 32, the evolution of new mortgage loans, a nearly increase of 27%, but it's also important to mention that even with this increase, it is still not enough to substitute the mortgage loan portfolio, which means that we continue to have substantial amounts of redemptions, and we need to increase much more the new production in order to stabilize the final stock. In 2018, the mortgage loan portfolio, even with this increase in new loans, reduced by almost 1 billion euros in 2018. So moving to asset quality, on slide 34, we have the cost of credit risk, just 21 basis points, a small increase in comparison to last year. This is more a consequence of a policy that we decide to implement to reinforce the coverage by impairments of the NPL stock, rather than a real increase in the cost of credit risk. And we can see that on slide 35. So we ended the year with a NPE ratio of 6.6, NPL ratio of 8.5%, of which 5.5% are above 90 days, and a substantial increase in the coverage by impairments, which reach, in the case of NPL, 63.5%. And this compares very favorable with the European Bank's average. These are the data published by EBA and refers to September, but even though it's important to mention that CGD has a coverage ratio of almost 20% more than the European average. On slide 36, we have the evolution and the main drivers for this NPL reduction. In 2018, the main driver was the portfolio sales, 1.2 billion, but it's also important to mention the cures with 500 million, and also the other, which are mainly cash recoveries of 400 million. So we ended the year with 5.2 billion in NPLs, but these are gross of impairments. If we consider net of impairments, the stock would decrease to 1.9 billion. And this 1.9 billion would represent 3.3% of the total loan portfolio, which is what we present in the left side of this slide. Also on slide 37, the evolution of the foreclosed assets, finally a substantial reduction in the portfolio, almost 25% in 2018. Here the coverage by impairments is pretty much stable, as we consider that there are no reasons to increase it since the real estate market in Portugal continues to perform very well. So moving to liquidity, on slide 39, the ECB funding, the group has only, in December 18, 471 million in ECB funding, and this all relates to our subsidiary in Spain. So in the domestic activity, the group repays already all the TLTRO. CGD did that in June, and our investment bank did that in the last quarter of the year, so we have just 471 million. In terms of the eligible assets pool, it's pretty much stable. There's a reduction since 2017, which is mainly driven also by our subsidiary in Spain, because they use that to repay also part of the funding they have from the central bank. On slide 40, we have the wholesale debt maturities, pretty much light calendar for those next years, and totally covered by the eligible assets pool, which means that the group for sure won't face any troubles in the funding planning for these next 2 to 3 years. On slide 41, picture on the funding structure of the bank, and we can see in a very substantial amount the funding is based on the clients, on the retail clients, especially on the deposits, and this is also translated in the loan to deposit ratio of 81% in December 18. Which is also a consequence of the stabilization or a small increase in the deposit base and the reduction of the loan portfolio due to the NPLs and to these elements, these facts that I already referred of the reimbursement from the public companies and general government. On slide 42, we have the LCR, 226%. There's a decrease in comparison to the third quarter, but this has just to do with the specific item, which is we have a covered bond maturing in January 2019, and this impacts the ratio because it's a substantial outflow for the 30 days after the date of the calculation of the LCR. So moving to capital, on slide 44 we have just a reminder of the recapitalization plan that was concluded back in June. On slide 45 we have the evolution of the yield in the secondary markets of the yield of the Tier 1 and the Tier 2. And on slide 46 we have the capital ratios fully implemented and phased in for the end of the year and compare it to the SREP requirement. It's important to mention that we haven't yet received the SREP requirement for 2019. We have just received a draft letter, but with that we don't envisage substantial changes in the SREP requirements for 2019. On slide 47, there's the evolution of the CET1 during 2018, where we can see that we have a substantial generation of capital, not only through P&L, but also from risk-weighted asset reduction. And the ratio was negatively impacted by some regulatory changes, namely the IFRS 9, where the group is not applying any phased-in period, also from the deduction of irrevocable payments, and these other regulatory adjustments are some adjustments in the treatment of minority interests that the ECB asked us to implement. So with that, we ended the year with 14.7%, and we can see on slide 48 the evolution on these last 3 years, and we can where we can notice that since the start of the recapitalization, the strategic plan, the consolidated CET1 improved already to 260 basis points. It would have been more if we don't have these regulatory changes, which represent a deduction of almost 75 basis points, almost more than 75 basis points. On slide 49, we present the usual risk-weighted asset density, small decrease, but still substantially above the European average, 54%. A very important improvement in the taxes ratio, which stands at 50% in the end of 2018, and the leverage ratio pretty much stable, 7.7% in the end of last year. Finally, in terms of available distributable items and the maximum distributable amount, very comfortable buffers, in any case above 2 billion, which means that there should be absolutely no problem with the payment of the coupons of the 81. Also important to mention that, and I think we discussed this in the last conference call, that it is our intention to pay dividends already in 2019 on the result of 2018, but this is a matter that is still in discussion with the ECB, and we should only release any decision for this on next April. Nevertheless, and as I already have the opportunity to refer, the group will always safeguard a very comfortable and substantial buffers towards the regulatory requirements on capital, and also in terms of the available distributable items and the maximum distributable amount. So finally, just to finish, on slide 52, just a wrap-up of the different dimensions, good evolution of the business, but of course the evolution of net interest income losing pace. The commissions we expect to gain some traction for next year. On asset quality, a good evolution, but we are still, and we recognize we are still far from our final target of below 5%. Liquidity, very comfortable position, and absolutely no problems for the funding of the group. And on capital, a very strong capital position, and that we will intend to continue to reinforce even with dividend payments. On slide 53, just to put things in perspective, we present the execution of these main targets, also the 2020 strategic plan, and we compare them with the European banking average, year being data from September 2018. So return on equity, the group is approaching the European average. Nevertheless, we have a demanding and challenging target for 2020 to be above 9%. On the cost to income, we are already substantially below the European average. Nevertheless, the target for the strategic plan is very ambitious, and we need to continue to improve. On the NPL ratio, we are almost in the target of 2020, but nevertheless, we are very far from the European banking average, which is our ultimate goal, is to converge to the European average. Finally, on capital, I would say we are still meeting the 2020 strategic plan, and we also compare favorable with the European banking average. So this is it. Thank you for listening, and we are now open to your questions.
At this time, if you would like to ask a question, please press the star and 1 on your touch-tone telephone. You may withdraw your question at any time by pressing the pound key. Once again, to ask a question, please press star and 1 on your touch-tone telephone. We'll go ahead and take our first question from Paul Fenner with Societe Generale. Your line is now open.
Hi, good afternoon, gentlemen. A couple of questions. I guess the first is in terms of issuance plans. I wanted to know if you can share with us whether you know what your MREL requirement is, and if so, what it is, and how you expect to fill it, and will you be doing any non-preferred senior or, in fact, any other capital product in the foreseeable future, particularly this year. And the second question I have is you've also obviously got some fairly aggressive targets which you've ratcheted up. How sensitive are your plans to a slowdown in economic performance? Obviously, Europe isn't in a great place. Italy is now in a technical recession. Spain is slowing. Can you give us a bit of color about what's happening in Portugal, whether there's any sign of the beginnings of a slowdown and deterioration in loan books, and what that might mean for your plans under the 2020 plan? Thank you.
Okay, thank you. Hi, this is Bruno. I'll take the first question. So regarding our MREL requirements, we still don't have the binding requirement from the SRB. We think we will receive it sometime during the first half of this year, first or second quarter. We do have already some indication from the SRB based on the conversations we had last year. In our case, the indicative requirement does not differ much from the general formula that has been used. There are some particularities in our case, given the resolution perimeter will include BNU Macau. But we don't expect any significant difference. Regarding issuance plans, of course, at this point, and in the absence of any liquidity needs, and in fact, with such strong capital ratios, we don't expect to have to issue any more subordinated debt in the near future. So our issuance will be focused on fulfilling the MREL requirements. Based on the indication that we have from the SRB and based on the projections that we have for the evolution of the balance sheet, We think we may have to issue something like 1.5 billion of securities over the next 3 years. Again, this is preliminary information just based on the indication we received from the SRB and based on our own projections. What that means is that we could, for example, issue one benchmark this year, 500 million, another one next year, another one the following year. Most likely this would be senior non-preferred debt, but it could also be senior preferred. Ultimately, this will depend on two things. First, discussions with the SRB and whether senior preferred can be accepted to also cover part of the shortfall. The other is feedback we receive from rating agencies, especially from Moody's, given that the new insolvency law, which we expect will be passed and published in Portugal over the next few weeks, will introduce a depositor preference in case of resolution, meaning that the non-guaranteed deposits will sit above senior debt in case of resolution. Because of that, Moody's has already put all Portuguese bank ratings under a negative outlook, and they will be looking for banks to, once they know what the MREL requirements are, they will be looking for banks to, disclose that to the market and at the same time inform the market on how banks expect to cover the shortfall that exists. So depending on what banks communicate to the market regarding the amounts and the formats of the instruments that will be used, Moody's may take this to mitigate the potential impact on the senior rating coming from the introduction of the new insolvency law. So to summarize, in a nutshell, based on the information we have right now, until the end of 2019, we may envisage issuing one benchmark to cover our MREL needs. Most likely it will be a senior non-preferred transaction, depending on market conditions. But as I said, this will depend on the final requirement we receive from the SRB, as well as on conversations that we will be having with rating agencies in the meantime. For the second question, I'll hand over to Mr. Brito.
Thank you. But also to refer on the first question, that as soon as we were provided with the binding targets for MREL, we plan to communicate to the market our issuance plan for the next 3 years. In line with what Bruno mentioned about the Moody's approach to this. So probably we will communicate that to the market, maybe we expect during the first half of this year. On your second question, yes, I agree there's some sensitivity to the economic performance of Portugal, but I would say I would like to mention two things here. First, I think a substantial slowdown could happen, but we don't envisage the economy to go into recession. And this could make a big difference, especially because, as you know, we, in the end of 2016, we made a very deeply and complete evaluation on all the assets of the group. So I would say that even with an economic slowdown, we shouldn't have a substantial impact coming from new NPLs or from the quality of the loan book. But we could expect maybe more difficult to reduce the actual NPLs, especially in terms of the drivers that are the most important, namely in terms of cures and cash recoveries, but also potentially in terms of portfolio sales. This could translate in more difficulty to sell this type of portfolios. So this is one of the reasons why we are trying to accelerate the reduction, and this is why we are setting more demanding targets. Nevertheless, it's important to mention that our balance sheet is nowadays much more protected to this kind of risks, also to these cyclical risks, but of course we could have some impact. On a different note, if this economic slowdown translates in more negative interest rates in the euro market, this could have also a substantial impact in the results of CGD. Of course, we don't expect this to happen. It's just a scenario, but I would say that we are much more sensitive to the evolution of net interest rates rather than the economic performance of Portugal as a whole.
Thank you.
Okay.
We'll take our next question from Samir Adatis with Citibank. Your line is now open.
Hi. Congratulations on your results, and thank you for the increased level of disclosures you now show in your slide deck. So I've got a number of questions. So firstly, do you expect any impact on the back of the TRIM exercise with many of your Spanish peers guiding to an adverse impact this year? On your revised NPL target of 5%, do you envisage any further large NPL disposals this year? In terms of the revised draft SREP, you said you do not envisage any substantial change. So do you assume the Pillar 2R will stay at 2.25%, or will this go down, but the net ratio will be unchanged because of phasing of buffers? On your ROE targets for 2019 and 2020, how much loan growth do you factor into this? And are these assumptions based on the current rates curve, or do you assume an increase in rates? And finally, as part of the agreed terms in the restructuring plan with the EC, when will you be allowed to pay a dividend to the government? Thank you.
Okay, thank you for your questions. So first, I think the first one is in terms of the TRIM exercise. We don't expect any change from this work from the ECB. As you know, we continue to be in a standardized approach in terms of the risk-weighted asset calculation. So we have some internal models for different purposes, but not for the risk-weighted assets. So from there, we shouldn't have any impact from the ECB. In terms of the NPL for this year, we are expecting a reduction of 1.5 billion, of which about half should come from portfolio sales. We are now working on the portfolios. This shouldn't happen in this first quarter. We envisage the first transaction maybe to be concluded maybe only on the third quarter of this year, but we are working to have a reduction of 1.5 billion in 2019. Concerning the SREP decision for 2019, from the draft that we received from the ECB, we might not have any reduction in the Pillar 2 requirements, but we might have a very strong reduction from the Pillar 2 guidance. Because, and I didn't mention this, but it's important to mention, the bank improved very substantially the result of the stress tests, and with this we will have a very substantial reduction in the Pillar 2 guidance. As you know, the Pillar 2 guidance is not disclosed to the market, but nevertheless, if we include that on the regulatory ratios, we would have a reduction of almost 1%, considering also the guidance. Finally, in terms of loan growth, we are projecting for the next 2 years loan growth of close to 2% for corporate segment and 0% for the household segment, which are not that much, but of course it's an important driver from our strategic planning. In terms of net interest rates, what we have, our planning exercise is based on the market, on the forward rates in the market. So we just have the Euribors to become positive in the last quarter of 2020. Okay, so in our planning, we consider negative rates for all the 2019 and for the first 3 quarters on 2020.
I believe there was also a question on dividends.
Oh yes, the dividends. The dividends, our plan is to pay already this year, in 2019, based on results from 2018. The process is we will now discuss that with the ECB, and after the agreement or the non-opposition from the ECB, we plan to pay the dividends already this year. It shouldn't be more than, the impact shouldn't be more than 35, 40 basis points in terms of capital. No more than that. We will have always very conservative payout ratios, and in our dividend policy, we establish clearly the need to have and to work always with very comfortable buffers, because we are fully aware that in a downturn or in a circumstance where the bank needs capital, we cannot raise that capital on the market. We all need always to go through this process of the state aid evaluation. So, having said this, we will always work with very comfortable buffers on the capital ratios in comparison to the regulatory requirements.
Just adding to that, net of the dividend payment, you aim to continue to run above 14% fully loaded CET1 ratio, or part of this year, could you fall below 14%, but the plan is to end the year above 14%?
Always above 14% after the dividend payment. Always above. If by paying dividends we will fall below 14%, we will recommend not to pay dividends. And I would say more than 14%, this is our target, but we would like to work close to 14.5%.
That's very clear. Thank you.
Thank you.
And once again, if you would like to ask a question today, please press the star and 1 on your touch-tone phone. We'll take our next question from Alexander Latter with PGIM. Your line is now open.
Hi there. Just a couple of questions from me. So just going back to the preferred deposits comment, just on interbank deposits, do you know if those will be included in the deposits that get preferred, or will they stay pari with senior preferred debt? And then we talked about TRIM earlier on, but are there any other regulatory headwinds to capital that you might not have mentioned earlier on, thinking IFRS 16 or something like that?
Hi, I'll take the first question on deposits. The way the draft law came out, I believe it referred only to client deposits, i.e. non-guaranteed client deposits, be it from individuals, from corporates, or from institutionals. I don't think this would include deposits from other financial institutions. But this is my own interpretation of the draft law. Regarding the
capital ratios, yes. Well, we don't envisage any additional regulatory changes that could impact the capital ratios. But having said this, it was also a surprise for us when the ECB decided that we should deduct the irrevocable commitments. It was a surprise because it was something new. In this year, this question of the minority interest was just a technical question, a technical issue. What could happen, but we don't know, is that backstop that is being discussed concerning the NPL coverage by impairments. But even for that, it won't impact materially our capital ratios. But apart from that, we don't expect any additional changes or regulatory impacts.
Great, thanks very much.
Again, that is the star and 1 keys if you would like to ask a question today. We'll take our next question from Corinne Cunningham with Autonomous. Your line is now open.
Thank you, and thanks for the call. Just wanted to follow up on MREL. I know you can't say much until you've got your detailed and final binding plans, but can you give us a feel for the resolution plan, the resolution style that you're expected to go down? Would that be an open bank resolution, a transfer, is it single point of entry, multiple point of entry? Is there anything you can tell us along those lines?
Based on the conversations we've had with the SRB so far, in the case of Caixa, it will be a multiple point of entry kind of strategy. The resolution perimeter would include Caixa and all its presence in Europe, in the banking union, plus BNU Macau. So BNU Macau is the only subsidiary outside the EU space that would be included in the resolution perimeter, just given the size and importance of the subsidiary and its importance more in the past than these days for intergroup funding and profitability. And I believe that's pretty much it. That's the information we have. Yes.
Okay, thank you.
Again, that is the star and 1 keys if you would like to ask a question, and we will pause a moment to allow any further questions to queue. It does appear that we have no further questions at this time. And speakers, it looks like we have no further questions at this time.
Okay. So thank you very much. Any further questions that you would like to raise in the future, please contact our investor relations. Bruno Costa and his team were always available for your answers. Okay? So have a nice day and thank you very much.
Thank you.
Thank you for attending the conference call. The audio webcast will be available in Caixa website.